G'day and welcome to this week's weekly dose video. I've got Amy with me this week.
You do?
Yeah, and we just finished a quick podcast and we thought we'd just cover off briefly on what the topic is, and that is finding awesome businesses, what we look for and what we think is important.
Yeah, and if you want a more in-depth explanation, definitely go check out the podcast.
Yeah, so this will be the 3-5 minute overview of what we spoke about and covering off the main points from the podcast and to what we're looking for in businesses that listed on the stock exchange, and some of the key things that we think that you need to look for. And again, this is all about information education. So first, Amy, what are we looking for?
First off, we start with the sectors that we're interested in, and we want to make sure that there is some some structural growth behind it and some tailwinds that we can jump on and take advantage of moving forward.
Great. So have you got an example of an awesome structural tailwind where people are using a certain sector or products more?
Yeah, well, definitely a tailwind that we're seeing that can be applied to many different sectors is climate change. There's supposed to be approximately $100 trillion worth of investment going into climate change and combating that over the next 30 to 50 years. So there's going to be a lot of businesses that benefit from that.
Yeah, and even locally we're seeing with companies like Coles and Woolies that they are stating in their advertising that they intend to be carbon neutral by 2025. That's going to take a lot of investment.
Yeah.
Other structural tailwinds, other sectors that we like, can be cloud computing. It can be obviously semiconductors. It can be the businesses like Visa and MasterCard, which are making it easy to transact. There is still a transition from using cash to cashless, and COVID has definitely exacerbated that. So once we've found a decent sector, we also like to look at who runs the business, and do these people running the business actually own it?
Yeah, everybody knows, if you've got a bit of stake in the company that you're working for, you're going to work harder for that company and increase its growth for yourself and your family in the business because it's your passion to do so.
Yeah. So skin in the game is vital, and we think that there are a lot of studies being done on that point, that the more that they own, a decent interest, they've got skin in the game, and they will work harder for themselves and their family, and therefore us as shareholders. So that's a positive one. Another
thing we look for is making sure a company has quality products and services that consumers rely on and hopefully go back to time and time again. We talked about in the podcast, a bit of an example was, Apple and Android, you either one or the other. You don't jump ship, and you definitely don't go to a unknown smaller brand. So having a good product and service that other businesses can't just take over and take your market share is really important as well.
Absolutely. And another classic example, and in our world here as financial planners and providing advice to people, and all the the business software we use is really related to Microsoft. And over the last since we went to Office 365, there are so many third-party apps for booking appointments or doing online forms have been replaced by Microsoft. And it may be seen as anti-competitive, but it's a monopoly. We do not need to go anywhere else for those services. So Microsoft, obviously, very high quality products, and therefore the business is amazing. We also love a really good, healthy balance sheet.
Definitely. The healthier the assets over liabilities, the more or the less risk there is that business can go under. And the healthier the balance sheet, the stronger the business is, essentially. And
they can make it through tougher times. You've got to try not to hit the table as much. Don't touch the table. Healthy balance sheet can make it through tough times, and recession is a word that's been spoken about a lot at the moment. So having good cash reserves to make it through those times is vital.
We also really love a business that does a lot of research and development and puts retained earnings back into themselves.
Yep. So what that means is, instead of paying out 100% of their profit, they're paying out some as a dividend, but keeping some and reinvesting back into the business for future growth. Because if a business, and Telstra is a very good example of that, where in some years they were not, they're paying out 100%, and in fact over 100% of the profit they made, that's not building the business. That's not reinvesting for future earnings and profitability.
Yeah, and we've seen that in the Telstra share price. It hasn't really gone anywhere, has it?
Absolutely, it hasn't gone anywhere for 20 years. And if you want to compare that to a business that does pay a very low dividend but reinvests heavily, that's CSL. I think, Amy, that's probably enough for today.
Plenty more we talked about, so definitely if you want to listen to more of us, check out the podcast.
Yeah, you don't have to see us, so that's a bonus as well. Thanks for listening, and we'll catch you next week.
Thanks,
Cheers.
everyone. Bye.
Bye.